Welcome to the Deep Dive, the Talk Tickers edition. We're here to break down the key earnings calls so you get the crucial insights without wading through hours of transcripts. Today, we're zeroing in on Equinor ASA, ticker EQNR. Their Q3 2025 results just dropped before the market opened on October 29th.
Yeah, and this one was really interesting, a classic case study, you could say.
How so?
Well, you had this big headline miss on earnings, but underneath that, stellar operational performance, really strong execution.
Okay, so a real divergence there.
Exactly. It forces you, the listener, to think about what really matters. Is it the short-term accounting stuff or the long-term ability to actually produce?
Got it. Let's unpack that. So give us those top-line numbers that created this mixed picture.
Okay, so the adjusted EPS, earnings per share, landed at 37 cents.
Unlike consensus was looking for.
It's 57 cents. So yeah, a pretty significant miss there, like 35% below expectation.
Ouch. And the GAAP result.
That was actually a net loss. $0.2 billion reported loss on a GAAP basis.
Okay, so purely on those earnings metrics, it doesn't look great.
Not at first glance, no. But then you look at revenue. $26.06 billion.
Okay. And the street was expecting
$23.26 billion. So a solid beat on the top line.
Interesting. So where did that revenue strength come from if earnings missed?
Production. That was the anchor. They pumped 2.13 million barrels of oil equivalent per day. That's in BOD.
And how does that compare?
That's up a really strong 7% compared to the same quarter last year. 7% volume growth is significant.
Wow. Okay. And what's driving that growth?
It's largely the big Norwegian fields ramping up. Johan Sverdrup continuing its plateau production, and Johan Castberg really kicking in now too.
Right, those core NCS assets. So how did the market react to this disconnect? Big EPS miss, but strong production and revenue.
Well, that's the fascinating part. The reaction was pretty muted, actually. In Oslo, the shares dipped maybe 1.4%, something like that.
And the US ADR
closed slightly positive on the day.
Really? Despite the 35% EPS miss and the GAAP loss.
Yeah. It tells you the market looked straight past the accounting noise, or at least significantly discounted it. The focus snapped right to the operational delivery, the quality of those barrels.
So investors prioritize the physical production and the growth story over the reported profit figure for the quarter.
Precisely. They saw the value in that stable, high-margin NCS production, that predictable cash flow potential, plus the growth outweighed, temporary financial hits like impairments. Long-term asset stability won out.
Okay, let's drill down into those financials a bit more then. What drove the adjusted operating income?
Right. So adjusted operating income pre-tax came in at $6.21 billion.
Which was down year over year.
Down about 10%, yeah. The main headwind there was lower liquids prices compared to last year. That definitely hurt.
But offset by?
Offset significantly by those higher production volumes we just talked about. And they also pointed to strong performance in their U.S. gas operations.
Okay. Now, we have to talk about that GAAP loss. You mentioned impairments. Let's get into that.
Yeah, it's absolutely key to understanding the quarter. Net impairments hit $754 million.
And that's not just like random accounting stuff. It reflects a real view.
Exactly. Management is basically saying, based on our updated view of long-term commodity prices, some assets aren't worth quite what we thought. It's them taking a more cautious, maybe realistic view, de-risking the balance sheet, essentially.
Where did those hits land specifically?
Two main areas stood out. About $650 million was linked to EP international assets. These are ones being transferred into that ADNOC IGV joint venture.
ADNOC IGV, remind us.
Abu Dhabi National Oil Company's integrated gas value chain. Basically, assets held for sale now, valued based on those lower long-term price forecasts.
Got it. And the second area?
$385 million in impairments booked against the U.S. offshore assets.
Okay. But you said net impairments. Was there anything going the other way?
There was, yeah. Positive offset. They actually reversed a previous impairment at the Mongstad refinery. About $300 million positive impact there.
Why the reversal at Mongstad?
They're expecting higher refining margins going forward than they previously assumed. So that improved the outlook for that asset.
Okay. And speaking of Mongstad, there was some tragic news there too.
Yes, unfortunately. Management acknowledged a fatality occurred at the site during the quarter. They stressed safety is the absolute priority and that they'll fully implement all the learnings from the investigation.
A sobering reminder, definitely.
It really is. Even with strong operational results, the risks are always present.
On a different operational note, what about costs? With inflation and higher production, were costs running hot?
You'd think so, but actually, no. Year-to-date operating costs are basically stable compared to last year. which is impressive given the growth in inflation.
How are they managing that?
Demonstrates real cost discipline.
Ooh.
Management specifically highlighted that costs in the renewables part of the business are down significantly, like around 50% year over year.
Okay, stable costs are huge for maintaining profitability and capital discipline. Let's pivot to guidance then. Was there any big change there?
Well, yeah. The biggest shift was in the marketing, midstream, and processing segment, MMP.
What changed?
They lowered the quarterly guidance for adjusted operating income from MMP. The new guidance is just around $400 million.
Around $400 million. What was the old range?
It was much wider, $400 million on the low end, but up to $800 million on the high end.
Wow, so they basically chopped the top half off the expected range. That's a big move. Why? Overly optimistic before, or is the market fundamentally different now?
Management argues it's the market. Two main things. First, that extreme volatility we saw in the European gas market, especially after the conflict started, that's calmed down, normalized.
So fewer opportunities for those massive trading profits.
Exactly. The arbitrage opportunities just aren't there to the same extent. Second, there was a specific impact from selling off some gas transport assets earlier. They said that accounts for about $40 million per quarter less going forward.
Okay, so structural changes driving that lower MMP outlook.
Yeah.
Did they give any color on risk around that $400 million number?
They did. They stressed they actually see more potential upside than downside risk to that $400 million figure. So it sounds like they're trying to set a pretty conservative floor there. Well, prudent guidance.
Makes sense. Okay, so M&P guidance down. What about the core business, E&P, production guidance, CAPEX?
Core story still looks very solid. They reaffirmed the plan to hit around 4% production growth for the full year 2025.
So Q3's 7% growth helps get them there.
For sure. And capital expenditure, CapEx, is still pegged at roughly $13 billion for the year. No change there.
And any new projects coming online to support future growth?
Yes, a big one. They confirmed the startup of the Bakalhau project in Brazil. That happened in October.
Bakalhau. That's a major deepwater field, isn't it?
Huge pre-salt development. It's expected to be a really significant contributor to their international earnings as it ramps up through 2026. It fits that theme of bringing high-margin barrels online.
Good stuff. Okay, let's shift gears now to shareholder returns. Despite the EPS miss, how did they treat investors? Dividends? Buybacks?
Yeah, this is important. They kept the returns flowing. Approved the ordinary cash dividend, 37 cents per share. Consistent there.
And buybacks.
Launched a new tranche, about $1.27 billion. So if you add it all up, the total capital distribution for 2025 is looking like around $9 billion. Pretty substantial.
So returning cash remains a priority, even with accounting headwinds.
Clearly. And that ties into maybe the most interesting strategic move they discussed, the Ørsted investment.
Right. They participated in Ørsted's big rights issue. Tell us about that.
They did. They put in about $900 million in capital in Q4. And crucially, they announced they intend to nominate someone to Ørsted's board.
So moving from just holding shares passively to being an active, involved shareholder.
Exactly. An active industrial shareholder is how they seem to view it.
But why now? Ørsted and the whole offshore wind sector seem to be facing some serious challenges, cost inflation, supply chain bottlenecks. Why jump in deeper now?
Management's framing is interesting. They basically said, look, the offshore wind industry is hitting its first real downturn. There are challenges, yes, but that also creates opportunities.
Opportunities like consolidation or picking up assets cheaply?
Potentially. They see it as a chance to gain, industrial insight and maybe even leverage. They think their experience managing big projects through cycles could create value here, perhaps positioning for selective M&A if things get worse for others.
So it's a strategic foothold, maybe even opportunistic, rather than a sudden pivot towards massive wind investment.
That seems to be the message, and they were very, very clear on this next point.
Which is?
They will limit further capital commitments to offshore wind for the time being. There's a high bar for new investments there. They're focusing on finishing what they've already committed to, like Empire Wind.
Okay, so discipline remains key, even with this Ørsted move. What about Empire Wind's funding?
They did mention that it needs a $2 billion equity injection in 2026, but they expect that to be largely offset by the investment tax credit, the ITC, coming back in 2027.
Got it. This capital discipline focus seems to fit with their market view as well. What did they say about the global gas market outlook? That impacts the MMP segment directly.
Yeah, their view is quite nuanced. Short term, for this winter in Europe, they see it as tighter than maybe people think.
Tighter? Why? Storage levels looked okay?
They're around 83%, which sounds high, but it's actually 12 percentage points lower than this time last year. So it makes the market much more sensitive to weather this winter. Weather becomes the dominant factor for price swings.
Okay. And longer term, lots of new LNG supply is coming online, right?
It is. But they see demand, particularly from Asia, staying pretty healthy, growing maybe 3% a year, enough to absorb a lot of that new supply over time.
Anything else notable on the gas front?
One interesting point in the U.S. market, they noted that U.S. natural gas is starting to become a bit of a domestic political issue.
Why?
Because of the sheer power demand coming from new data centers, AI expansion, that sort of thing. This massive domestic demand growth could, down the line, put some unexpected constraints or political hurdles on future LNG export approvals. Something to watch.
Definitely a dynamic to keep an eye on. Okay, let's pull this all together. It's time for this segment where we synthesize this into a potential angle, always remembering.
This is not financial advice.
Exactly. But based on everything we've heard, the operational strength, the capital returns, the careful pivot on renewables, what's a thesis that jumps out?
Well, given that clear execution and strategic recalibration, here's an idea for you to consider.
All right, let's hear the trade idea.
Long Equinor, short a U.S. pure play renewables ETF or index.
Okay, explain the thinking there. Long Equinor.
Because they are executing beautifully on their core E&P business. They reaffirm that 4% production growth. You've got high margin barrels coming from the NCS and now Bakalhau ramping up in Brazil. They're disciplined with capital, shown by the Ørsted caution and the focus on returns at $1.37 in dividend, the buybacks. It's about reliable cash generation.
Makes sense. And the short side, shorting pure play renewables.
Yeah, this hedges the energy sector exposure, but specifically targets the part of the sector Equinor seems to be prudently stepping back from. Many pure play renewables companies are still facing the headwinds. Equinor is trying to manage carefully high leverage, project delays, cost overruns, supply chain issues like those vessel disputes impacting projects like Empire Wind.
So you're essentially betting on Equinor's pragmatic, cash-focused strategy, winning out against the companies still stuck deep in the capital-intensive, lower-return struggle of the current renewables development cycle.
That's the core idea. You capture Equinor's strength while hedging against the sector's pain points, where Equinor is showing discipline. It leverages their operational success and strategic caution.
Okay, a compelling thesis built directly on the quarter's themes. So, wrapping up, Equinor served up a really split quarter, didn't they?
Absolutely. You had the EPS miss driven by impairments and market normalization in MMP. But underneath, it was frankly a masterclass in operational execution, keeping costs flat, growing production significantly, and making some very clear strategic choices about capital allocation, especially concerning renewables.
It really highlights that need to look beyond just the headline numbers, which leaves us with a final thought for you, the listener, to chew on.
Go for it.
Considering Equinor's focus now hitting production targets, getting Bakalhau online, limiting new wind capex despite the Ørsted move, even needing that $2 injection for Empire Wind next year before the ITC kicks in,
Yeah.
will the market start to increasingly price Equinor more like a reliable, cash-generating traditional E&P company and less like a potentially capital-hungry, somewhat volatile energy transition play? Is that the re-rating story to watch?
That's the big question, isn't it? Where does the market ultimately place the value?
Something to track in the quarters ahead. Remember, everything we've discussed today is based on public earnings call information and is purely for informational purposes.
It is absolutely not financial advice.
Definitely not. Thanks for tuning into The Deep Dive. Go forth and be well informed.